Hello financial fans, welcome back to another stock analysis. Today we'll be covering Bank of America stock ticker BAC. Bank of America is a multinational financial services company that provides a wide range of products and services to individuals, small businesses, and large corporations. Here are some of the things that Bank of America does. First of all, consumer banking. Bank of America provides traditional banking services to individual customers such as savings and checking accounts, loans, mortgages, credit cards, and financial planning. Secondly, they do business banking. Bank of America offers a range of banking services to small and large businesses, including loans, lines of credit, merchant services, payroll processing, and treasury management. Third, investment banking. Bank of America provides investment banking services, including underwriting and issuing securities, advising on mergers and acquisitions, and helping companies raise capital. Wealth management. Bank of America provides wealth management services to high net worth individuals and families, including investment management, trust and real estate planning, and philanthropic services. And lastly, we have global markets. Bank of America operates a global markets division that provides trading and risk management services to institutional clients, including corporations, governments, and hedge funds. They are currently sitting at a $242.3 billion market cap, and in 2022 they generated a revenue of $115.6 billion, and the dividend yield is sitting at 2.91%. 27% of their revenue comes from non-interest income, 21% from interest, 11% from global wealth and investment, 14% from global markets, 10% from global banking, and the remaining 17% from consumer banking. To determine the final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. And we will be using a standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction in a margin of safety. The first metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $3 billion in 2012 to $27.5 billion in 2022. The average EBIT growth was 8.7%, meaning no change in the margin of safety. The margin has also gone up, going from 3.78% in 2012 to almost 29% in 2022. The average margin growth was 23.4%, meaning a 5% deduction in the margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years, going from 1 cent in 2012 a share to 22 cents a share in 2022. The average dividend growth was 19.6%, meaning a 10% deduction in the margin of safety. This with the payout ratio sitting at a very low 27%, meaning they still have room left to increase their dividends further. This gives them another 5% deduction in the margin of safety. The last ratios that we'll be looking at are the debt to EBITDA and assets under management CAGR. To get our debt to EBITDA ratio, you have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. As you can see in the top left, their cash position is currently greater than their debt position, meaning that they have no net debt. This indicates a 0% debt to EBITDA ratio, which is a 5% deduction in the margin of safety. Assets under management CAGR has gone up, going from $2.2 trillion in 2017 to $3 trillion in 2022. The CAGR in this on 5-year basis is 6.3%, meaning a 5% deduction in a margin of safety since it's greater than 5%. Looking very good so far for Bank of America. Let's go look at the valuation models next to determine the intrinsic value of the stock. The first valuation model that we use is the dividend discount model. I've imported the dividend payouts of Bank of America going from 2018 to 2022. The average growth rate in dividends during this period was 10.36%, and I'm projecting an expected growth rate of 6% in their future dividends. I will be using a 9% discount rate in this valuation, giving us a dividend discount model price per share of $31.09, which is a 2.72% upside from the current price. The second model that we use is Graham's revised valuation formula. In this model, we look at the earnings per share that Bank of America is generating. The P of a company with no growth is always at 7, as Benjamin Graham intended in his theory. We look at the growth rate estimate projected by Wall Street, and we look at the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. This gives us a Graham's price per share of $35.09, which is almost a 16% upside out of this model. The third model that we use is the multiple valuation. In this model, we look at similar companies to Bank of America, look at their stock price and earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 10.29. Then, all that's left to do to get our intrinsic value out of this model is to multiply by the earnings per share that Bank of America is generating, which is $3.19 a share, giving us a multiple valuation price per share of $32.83, which is an 8.44% upside out of this model. And the fourth model that we use is the price to tangible book value in relation to some of the peers in the industry. Price to tangible book value is a good valuation method for banks because it measures the market value of a bank relative to tangible assets, which are typically more stable and reliable than intangible assets. This makes it easier to assess the bank's financial health and potential risks, which is important. In this case, we take the tangible book value of, in this case, JP Morgan, Wells Fargo, and Toronto Dominion Bank, divide them by the shares outstanding, giving us the tangible book value per share, and then dividing this by the price, giving us the price to tangible book value. On average, for the peers, this is sitting at 1.52. Doing the same for Bank of America, we get a price to tangible book value of 1.38. This indicates that it's currently slightly undervalued, giving us a 10.34% upside out of this model. And the last model that we use is the cost to income ratio. In this model, we do pretty much the same as in the last model, but in this case, we look at the interest expenses and the interest income, giving us the cost to income ratio. On average, for these same peers, we get an average cost to income ratio of 30.92%. Doing the same for Bank of America, we get a cost to income ratio of 38.32, which in this case is a negative sign, giving us a price per share of $24.43, which is a 19.3% downside out of this model. If you want access to all of the models that I use in my videos and more, you can check in the description for my Patreon link. Getting that self-promotion out of the way, let's look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted dividend, Graham's valuation, the multiple valuation, the price to tangible book value, and the cost to income, price per share, giving us an average of $31.37. Our margin of safety we've determined earlier using a standard margin of safety of 25%, deducting it by 5% for the margin growth, 10% for the dividend growth, 5% for the payout ratio, 5% for the debt to EBITDA, and 5% for the assets under management CAGR, leaving us with no margin of safety at all, giving us a fair value of $31.37. And with the current price of $30.27, we get a small upside of 3.62%, indicating that it's currently a moderate buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.